Okay, well, thank you for joining this session. We only have 15 minutes, and we're going to cover a very hot topic in the crypto space. We're going to be talking about decentralized finance and about some of the analytics, some of the metrics, some of the indicators that you should be using to understand that can help you better understand this space. So we have a lot of ground to cover, a lot of content to cover, so I'm going to go really fast. A quick intro about myself. My name is Jesus Rodriguez. I'm the CEO and chairman of Into the Block. We're a crypto analytics platform that provides metrics, indicators, market intelligence to a large part of the crypto ecosystem. I have had a long career in tech, including 10 years as a distinguished engineer at Microsoft, building quant systems in Wall Street, been a two-time entrepreneur with successful exits. These days, I have invested in over 20 AI and crypto companies. I teach at Columbia University, and I do a lot of speaking and writing, and publish a newsletter about artificial intelligence that you can check out at the sequence.ai. A little bit about Into the Block. We started this project about 18 months ago. Today, the platform has over 120 clients, including some of the top brands in the space, in the crypto space, such as Binance, CoinMarketCap, Blockchain.com, Bitcoin.com, Revolut, Uniswap, and many others. You can check out the platform at appintotheblock.com. And really what we do is collect every single data point that we can about crypto assets and provide a lot of data science models and machine learning models that are extracting intelligence from this new asset class and providing indicators that can help retail institutional investors better understand the space. Part of that value proposition has expanded into the decentralized finance ecosystem. So today we provide a ton of analytics for DeFi, and this is precisely what I would like to cover in this session. So I would like to discuss some of the key challenges of analytics, of understanding the decentralized finance market, some DeFi analytics and indicators that would really challenge your conventional belief about the space, and just to spend a few minutes at the end talking about the future of DeFi and how we see intelligence in that regard. Let's start with a little bit of a bold statement. So decentralized finance, to me, it encompasses everything that crypto should be about, and it has the opportunity of enable the most intelligent vehicles or products, primitive in the history of capital markets. Why am I saying that? So decentralized finance today is about programmability, but in the future that programmability could become intelligent and enable a new series of constructs of primitive that we cannot do today with traditional vehicles. What do I really mean by DeFi intelligence? Like that term, what do we really mean by it? Why is DeFi more intelligent than alternative? Well, if you think about the traditional life cycle of a DeFi protocol, everything happens on chain. So all the interactions, all the transactions that happen in a DeFi protocol, they leave data, an on-chain footprint of data that could be used to generate market signals that could be incorporated into DeFi protocols that generate new data, and we have this cycle that is constantly producing better and better intelligence. So this is a very optimistic perspective. From this angle, we can see a path towards DeFi becoming really intelligent, but there is also a lot of important friction points that should not be ignored. Among the biggest challenge to incorporate, to understand DeFi protocols, well, we have the intrinsic complexity of many of these protocols. It's just hard for a normal retail investor to understand a protocol like Balancer or Uniswap or things like that. There is also an important aspect that is between the protocol and the data that protocol generates. So take an automated market maker like Uniswap. That protocol generates a lot of on-chain footprint data that could be analyzed. But then there is a gap between that data and the behavior of the protocol itself. So it requires a lot of analysis to get from those data points to understand the behavior of the protocol, and it is far from trivial. And there is also the fact that most of the interactions in DeFi happens across many, many protocols. So this, you add a level of exponential complexity to this challenge. What are things that we shouldn't do? And this is a little bit of a bold statement, but when we think about the DeFi space, when we think about, when we looked at it through the lens of an analyst, what are things that we should try to avoid doing? Well, this metric, the total value log, has sort of become the most important metric in the DeFi space that tries to measure the total amount of capital allocated to a specific protocol. So the total value log, it definitely brings a lot of value and simplicity to in order to understand DeFi protocols, but it's also very misleading. So we call this the single indicator fallacy, and it's one of the things that we should avoid when trying to understand DeFi protocols, because it is impossible for a single protocol to provide intelligence across a very, very diverse ecosystem. So some hard lessons that we have learned to trying to understand this space that could be extrapolated for a retail institutional investor. Value log, as I said, it could be a very misleading metric. So I'm going to show you some examples of it. The DeFi market is highly inefficient and unpredictable. So you see all sorts of puzzling behaviors all the time. Different protocols require different type of analytics in order to be analyzed and understood, and then you should expect very weird things to happen every single day. And I'm going to show you some very funny examples of that. So in the second part of this session, let's look very quickly at some fascinating indicators and insights about the DeFi market. And our goal here is to give you a perspective of the things that you should be looking at when trying to understand some of these protocols. I'm going to go through it very quickly, but hopefully it's going to highlight some perspective in terms of how you should try to understand this market. One metric that we pay a lot of attention to is the amount of Bitcoin going into DeFi protocols, because that gives you a perspective of, you know, the Bitcoin holders switching into DeFi and vice versa. Into the blog, we have this analysis called the Bitcoin lock on Ethereum, and you can see historically how it evolved. Some of these metrics are running in this deck until October, but if you go into the blog, you will see the current version. But in essence, it's the same. You can see whether it's increasing, it's an indicator that Bitcoin holders are going into DeFi. When it's decreasing, it's vice versa. DeFi holders switching back into other asset classes like Bitcoin. So this is a metric that is a very strong indicator of DeFi activity in the context relative to the macro crypto space. So value log and blockchain activity reveal very different perspectives. So this is a very interesting thing. So when we look at the top projects by value log, you can see that a project like Uniswap dominates. So you could extrapolate that the blockchain activity of Uniswap should be higher than most of the other protocols, but that's not really the case. When we look at the active addresses on chain for some of those protocols, you can see that the number of Uniswap addresses have been declining, which means there is activity, there is value log, but within the same set of addresses, but then something like that has been increasing. So this is an example of why value log could be really misleading. And here's another one. So in the context of lending protocols, which is a key use case in DeFi, we look at value log, and Maker by far dominates. But then when we go deeper and look at the actual loans outstanding or some of those protocols, you can see that Compound vastly surpasses Maker. So again, another perspective why value log, it could be a misleading metric when you try to generalize it across very, very different types of analysis. So one thing that is important to realize if you're doing lending and borrowing in DeFi is that lending rates and borrow rates are very different across different protocols. So look at borrow rates here across different protocols and across different tokens and look at the different rates. So in DAI, for the Maker protocol, it's at 328%. The YDX is a very vastly different number. So you can do very simple arbitrage with these borrow rates, and it's something very, very important to realize. And the same with the lending rates. Look at this, right? There is very, very strong difference between some of these protocols. So you can make money literally borrowing and lending all day long between these things, because the market is so inefficient. That's going to change, but today that's really the case. One concept, one trend that is, we believe is here to stay, is this trend of automated market makers. So projects like Uniswap, like SushiSwap, like Balancers have been at the forefront of this new phase of decentralized finance, and it is together with lending is one of the most important trends in the space. When analyzing this type of projects, is sort of important. You typically look at two metrics of the different liquidity pools. You look at liquidity, like which pools are very liquid, and also which pools have a lot of volume. And many times they don't go together. So it's sort of important to realize that in this screenshot that is also extracted from the Into the Block platform, you can see that the top traded pools in terms of volume, you can see that the ETH to USDT dominate, but at the same, it's only number 3 in terms of liquidity, when the wrap Bitcoin to Ethereum dominating that. So this tells you that liquidity and trading volume are not exactly the same thing. And then on that same context, when you look at some liquidity pools, you can see that the behavior of some stable pools is very, very consistent. So in this case, we're looking at the Uniswap pool of Uni to Ethereum, and you can see that there are as many swaps from the Uni token to Ethereum than from Ethereum to Uni. So it goes very consistent. But then when you look at something like ETH to Bitcoin, by far, you can see that most people are swapping ETH for wrap BTC than wrap BTC for ETH. So you can see that it's consistently, the green line consistently outperforms the blue line, and this is something to pay attention to. One of the key challenges in DeFi protocols is this phenomenon called impermanent loss, which is referred to the fact that you put money in a liquidity pool expecting to get some dividends, but then you experience a loss compared to just holding a specific asset. And this is a real challenge, and this is why a lot of liquidity providers don't make any money. At Into the Block, we try to solve that, providing a simulator of impermanent loss, but this is an example of a case in which you're allocating $10,000 compared to in the ETH to Uniswap pool, compared to holding ETH, you will be experiencing a loss of almost 20%. So the fact, automated market makers make the process seamless, but that doesn't make that is risk-free. There is definitely a lot of risk there. And then one of the things that you should expect with DeFi projects is to be very inefficient, very volatile. We have seen incidents like liquidity in SushiSwap dropping like crazy. It has obviously recovered since, and is doing very well today, but you can expect massive swings like this that could really puzzle most of the most bullish investors. Then there is most of these projects, they have this concept of governance tokens, in which it allows you to be part of the governance network by using those tokens. Most of those are really not a great investment. So you can see in the case of Comp, we do this analysis of profitability about how many Comp holders are making money versus losing money. And a few months ago, it was only 6.5% of that Comp holder base that was really making money, where 85% was really out of the money. So not a great investment from the token holders perspective. And then finally, a few things. So in DeFi projects, you're going to see some behaviors that are just puzzling, and it will kill your most sophisticated analysis. This is a funny example that almost drove us crazy a few months ago. So we were looking at Compound, and we will see these spikes in user behaviors, and it was really, really hard to explain. And then looking at some analysis, more detailed analysis, we saw that spike was really correlated with an increase in USDC utilization ratio or lending rate. So a lot of investors were actively using USDC in Compound compared to traditional trends, but we couldn't explain why. And we went even deeper and then realized that a lot of that activity was coming from a single address, was originating from a single address. So we thought about market manipulation, all sorts of things, and then finally realized that it was really Coinbase that was providing an incentive for people to go test in Compound with a $3 incentive or something, and a lot of Coinbase users were flowing to Compound and doing this exercise and causing this ton of activity that we just couldn't explain. So you will see things like that are completely unheard of in traditional capital markets that will really puzzle the most analytical investor. So those are some analytics that I think are super relevant to understand DeFi protocols. Here's I would like to close this session with a quick idea about how the future of DeFi and market intelligence should intersect. So today, DeFi protocols are all about programmability and automation. You have automated market makers, automated lending, derivative insurance, things like that. A lot of that, the footprint that is left by those protocols is being used in predictive models, in trading strategies, in high-frequency trading models, and things like that. I believe that in the future, that intelligence will be embedded as part of the protocols. I mean, think about it. If you can actually code the behavior of the protocol, why not to incorporate intelligence as part of it? So think about an automated market maker that instead of doing a 50-50 split like Uniswap or a weighted average like Balancer, it actually uses a market signal triggered by a machine learning model to actually try to split find the most efficient split between two assets or multiple assets. Think about, we have a lot of tokens that are earning yield and things like that. Think about high frequency trading strategies that could be actually implemented in a single smart contracts, and you can stake your holdings in that strategy and earn returns. Think about the next generation of robo-advisors that could be completely on-chain and looking at all these protocols and give you signals about when to lend, when to borrow or stake in order to increase your holdings. And we think this is going to happen. Like, this is going to be a trend that will influence the next few years of decentralized finance. So a quick summary, just to conclude, the DeFi market is really a gold mine when it comes to market intelligence. Avoid the total value log fallacy. No single indicator can describe a highly heterogeneous market like DeFi. In order to understand and drive intelligence and extract meaningful value from these DeFi protocols, you have to go deep and you have to analyze each protocol individually. And we think in the future, intelligence will become a first-class citizen of DeFi protocols. If you're interested in more of that, check out the DeFi Insights page at the Into the blog and send us some feedback. We'd love to hear from you. So that's all I have. I hope you really enjoy this session, and I would love to get your feedback in the near future. You can contact me via email at jr@intotheblog.io or through my Medium page. Thank you very much, and I hope you enjoy the session.